Hello and welcome to youshallpass.com. This video is about reading 56, Introduction to the Valuation of Debt Securities. We cover pretty much the entire reading here, starting with the concepts of bond valuation and then going on to the technicalities, the terminologies, the market price quoting conventions, etc., all involved in an understanding and calculation of bond prices. The title pretty much lets the cat out of the bag regarding where we headed in this reading. Valuation is the determining of the fair or actual worth of a financial asset. And since we're talking about bonds or debt securities, then their valuation is the study of the effects of interest rates acting on cash flows over time. In essence, and quite usually in practice also, it's quite simple. You have a cash flow and you know how far from now it's going to occur. That distance from now to the occurrence of the cash flow becomes your time, or T. You have your interest rate, which in the exams will always be given, and using this interest rate you discount the cash flow over T back to present day, and that is your present value. If it's a zero coupon bond that we're talking about here, then this present value is also the price of that bond. For fixed coupon bonds, which pay coupons at regular intervals, the valuation process doesn't change much. It's pretty much the same as that for a zero coupon bond, just that the discounting process is repeated for each time there's a cash flow. You work out your cash flows and when they occur, which basically means that you work out how much and when are your coupons going to be, and how much and when is your principal going to be repaid. And then you work out the discount factors for each cash flow, discount all the cash flows back to present value using these discount factors, aggregate all the present values for each cash flow, and that's the price, the fair price for this regular coupon bond. Or you can just use the financial mathematics developed long ago by great men, talking specifically about annuities here. It's a regular coupon bond with a bullet maturity. So since each coupon is the same in size and occurs at regular intervals, you can just take the appropriate number of occurrences, as in how many coupons remaining until the maturity of the bond, and that number of coupons is your T, and the appropriate interest rate for the intercoupon period, that's your I, and that will obviously be provided in the exam, and you discount these cash flows back to present value using the annuity formula. The face value, which is bundled up with the last cash flow, needs to be unbundled from the last cash flow and discounted back using the discount factor approach, since it's a lump sum. You need to take care with the last cash flow because it's part coupon, which you've already discounted using the discount formula, and mostly face value. And you need to discount the face value separate from the coupon. But sometimes in the heat of exam conditions, a common error is to take the entire last cash flow, coupon and face value and all, and discount them all back to present value, which can cause double counting to the extent of the present value of the last coupon, which properly you've already accounted for using the annuity present value formula. Anyways, once you're done with the present values of both coupon and face value, you add the two present values together, and this sum is then the fair price of a regular coupon paying bullet maturity bond with T coupons remaining and an I interest rate. In the case of an amortizing bond, which is the one that repays principal in equal installments along with the regular coupons, you simply need the annuity formula. because all cash flows are equal in size and occur at regular intervals with no lumpy or unequal cash flows to upset the pattern. The methodology here remains the same. You count the number of cash flows, and that's your T. You determine the appropriate intercoupon interest rate, which is your I. Then you plug them both in the annuity formula to arrive at the annuity factor. You then multiply the annuity factor by the value of the cash flow to arrive at the present value for the entire cash flow series. And this present value for the entire cash flow series is the valuation or the fair value for a bond like this. So what kind of bonds are these? The nature of the payments of this bond, wherein you're getting regular payments of principal in equal installments along with the interest. These payments closely resemble those for mortgages, leases, and commercial or consumer real estate rental projects. So if a bond is paying out its principal in equal regular installments along with coupons, then chances are that that bond is built on a portfolio of mortgages or leases or real estate rentals or other such similar asset classes. So far, we've introduced three broad types of cash flows generated by bonds, and we've laid out the broad valuation theory or broad framework for their valuation. We've presented the regular cash flow amortizing bonds, although the kind of bond we've shown may be an extreme example of this type, since in practice such bonds are made of bunches of mortgages and leases or real estate rentals, and some of these assets are always defaulting or getting prepaid or something which will irregularize the cash flow. Nevertheless, the cash flows are still largely regular because there's a portfolio, and the point about treating them as annuities is still very much valid. Next up, we have the bullet bonds, which in fact is the most common type of corporate or sovereign bond. And here the coupons are regular annuity-like payments, and the principal or the face value gets repaid in one big lump sum at the end of the life of the bond. And in this case, you evaluate the coupons to present value using the annuity formula and discount the face value to present value using the discount factor approach. And then, of course, there's the zero coupon bonds, for which there's zero coupons to annuitize. All you have is this one big cash flow at the end of the bond's life, and you just see how big it is, how far it is, and you pull it down to present value using the discount factor approach.
All right, so far, all we've talked about is cash flow and T, that is time. And we've just taken I, or the interest rate, as a given. In the exam, the interest rate I will be a given. And in life, you can cheat by plugging several different I's into your model and seeing which one makes the most sense. But realistically speaking, and also for the sake of exams, it helps to develop some sort of coherent mental framework of why an interest rate is what it is and what it should be. I am going to go out on a limb here and say that if you've made it to bond valuation, it's inconceivable that you haven't covered the components of interest rates elsewhere in the CFA Level 1 curriculum. This topic props up in a number of places, in quantitative methods, in economics, financial analysis, corporate finance. So what we're going to do is we'll just do a quick run through of the various components of interest rates here before moving on to actual practical bond valuation. Interest rates are built on the risk-free interest rate, which is the interest rate on a bond that is free from all sorts of risks. Typically, that's the rate on The risk-free interest rate is the rate on short-term treasury securities. That is, whatever country we're talking about here, the short-term sovereign debt of that country is generally assumed to be the risk-free interest rate for domestic debt of that country. Then, on top of the risk-free rate, you tack on an inflation premium. That's the risk of inflation exceeding the interest rate on the risk-free bond, so thereby diminishing the investor's wealth. So the risk premium is the extra basis points on top of the risk-free rate, which you feel is adequate compensation for the risk of inflation outrunning the interest rate on the risk-free bond. Then there's the big one, credit risk. That's the risk that the entity that's borrowing money from you via the bond, that entity may not be able to pay you back in full. And depending on the credit rating of the borrower and the perceived risk characteristics of the bond, the premium for credit risk can range from none in case of uh, a country or sovereign debt that's perceived to be virtually risk-free, to say a few basis points in case of, say, most top-rated corporates, to a few percentage points, which we'll call speculative debt. Then we have the risk of not being able to buy or sell the bond at prevailing market prices due to drying up of liquidity in the market for that particular issue or in general market conditions. And while we're while we call this liquidity risk, what we're really talking about here is illiquidity risk. An example of illiquidity risk would be a situation where, say, the last trade for a thinly traded or less liquid security took place at 99 cents to a dollar, and the next trade takes place at, say, 97.5 cents to the dollar, or say at 100 cents to a dollar. In case of most liquid securities where there's a multitude of buyers and sellers available at any point in time and at any price, generally you won't find that much of a difference between the prices between two trades taking place within a reasonable time frame. The type of the bond, its maturity, the borrower behind the bond, the size of the issue, etc. These are all aspects that affect the liquidity of that bond, and by no means is that an exhaustive list. Naturally, once again, for short-term treasuries, which are short-term sovereign debt, liquidity risk isn't generally a problem, but this risk does increase as the term of the bond lengthens and as the credit rating of the borrower worsens. Then we have the maturity premium. Simply, it's the extra yield one demands for holding, say, a 10-year bond versus holding a 1-month treasury bill. After all, a lot can happen within 10 years. All the risks that may not appear to be much now, or may even be invisible, they can assume significant proportions in those 10 years. 2007, 2008 can strike again. The Greece of 2004 can, become the Greece of 2011. And somebody like, say, Lehman Brothers, which were masters of the universe, masters of the banking and the bond universe, came crashing down to dust in a matter of weeks. So, although risks like these can never, accurately be forecasted or priced for, the general idea here is that the longer in the future you're going to get your money back, the more uncertainty you're being asked to undertake. And the more uncertainty you're running, the greater should be the yield on top of the risk free that you should be demanding. I mean, it's only fair that in return for running extra risk, you get extra return.
There's a last couple of things that you need to understand here, and both are in relation to bond prices. We aren't talking about the valuation of the bonds, but their quoted prices in the market. The first is that the discount rate is generally the yield to maturity or the YTM on the bond, in the sense that markets are, generally broadly efficient, and under normal market conditions, they price risks fairly accurately. So the YTM that you are being offered on a bond, um, it's likely that it's incorporated all the risks that we just discussed. So in most cases, the appropriate discount rate which should be used to value a bond would be the prevailing yield on the bond. And this leads directly to the price of the bond. The axiomatic rule of thumb is that if the coupon rate on the bond is less than the yield to maturity or the YTM on the bond will trade at a discount. And if the coupon rate is equal or approximately equal to the YTM, then the bond will trade more or less at par, or 100 to face value. And if the coupon rate is greater than the YTM, then the bond will trade at a premium or above face value or par value. And finally, the effect of time. As a bond nears maturity, its price moves closer towards par, all other factors notwithstanding. And that's called the pull to par effect. Therefore, by extension, the closer a bond is to its maturity, the less volatile its price. And that obviously means that the longer that the bond has to maturity, the more volatile its price can be.
Here, we demonstrate how the price of a bond is calculated, how the YTM versus coupon relationship affects these prices, and how these prices change with the effects of nothing but time. We start off with two bonds which are identical in all respects. They have the same time to maturity of 10 years. They are assumed to have identical credit ratings and identical timing of cash flows. So it's consequently very reasonable to assume that the identical YTM or identical discount rate will apply to both. Let's assume that that required YTM is 8%. The only aspect that the bonds are different in is the coupon rate. One bond pays a 10% annual coupon and the other one pays a 6% annual coupon. Now, the first thing to note here is this. The bond world lives, breathes, and calculates in 6 monthly intervals. Pretty much everything is worked out over a 6 monthly time frame. So, in keeping with this convention, we've laid out the 10 remaining years of the bonds as 20 half years or 26 monthly intervals here. Next, we work out the discount factors and the annuity factors. Since these are calculated for half years, the convention is to work them out using half the annual discount rate, in this case 4%. And that is what we've used to work out the discount and annuity factors for the remaining half years of the bonds' lives. These factors are the first and second green columns and the first and second red columns in the slide. You are strongly encouraged to replicate these figures to get comfortable with how these are arrived at and later on how these are used. Just to recall, the formulas for the discount and annuity factors are presented here. So for instance, if we were to calculate the discount factor for standing at the point in time when there are 14 half years or 7 full years remaining in the life of the bond, the discount factor would be the reciprocal of 1 plus half the annual discount rate, that is 1.04 raised to the power 14. The annuity would be worked out by subtracting the discount factor from 1 and then dividing that by the interest rate used to work out the discount factor, being 4% here. As I said, you are strongly encouraged to manually work out and replicate the discount and annuity factors for a few more maturities presented here before proceeding with the rest of this video. Moving on, take a look at the third green and the third red columns. The numbers here are identical. These columns represent the present value of the face value of the bond. And since the face values are the same, and are paid out at the same points in time and are discounted using the same discount rates, it stands to reason that their present values at all points until maturity would be equal. The last row shows the present value as being equal to the face value, and that again is as it should be, since at that point in time the face value is payable immediately. Move on to the fourth columns in green and red, and that's where we evaluate the present value of the future coupons of both bonds. These numbers are obviously different for both bonds because the coupon rate for both bonds is different. One bond pays a 5% 6 monthly coupon, and the other pays a 3% 6 monthly coupon. Therefore, owing to the higher cash flow, the present value of the coupons of the premium bond is higher than that for the discount bond. And how is the present value worked out? Simply the amount of cash flow times the annuity factor. So at the point where there are 14 half years remaining in the bond's life, the present value of the annuity for the discount bond is 10.5631 times the value of the semi-annual coupon, that's 3. So the present value works out to 31.6894. Again, you should repeat the same working for the premium bond as well as repeat them for a few other time horizons for both bonds. Alright, so we have the present value of the face value and the present value of the coupons for all 6 monthly intervals over the remaining life of both bonds. The fair price of both bonds at any point in time would be the sum of the present values of the face value and the coupon. And here, that's shown as the fifth column in green and red. The fifth column being the sum of the third and the fourth columns. That's the fair price of the bond at that particular point in time. And if you've managed to replicate all the other workings so far, then this one's obviously not going to be that much of a challenge. Now, the bond prices shown here display two characteristics which I would like to bring out. The first is an axiomatic rule of thumb that the bond with the coupon rate higher than the required discount rate or the YTM, that bond trades at a premium, which means that it has a price above 100 to above 100 cents to a dollar of face value. The bond with the coupon rate lower than the YTM, on the other hand, trades at a discount or a price below 100 cents to the dollar. This is what we talked about a few minutes earlier, where we said that bonds with coupons higher than the YTM trade at premiums, and those with coupons below YTMs trade at discounts. The second point that I wish to bring out here is also one that we spoke about a few minutes earlier, that bit about pull to par. All things considered and all things notwithstanding, as time goes by, the price of a bond will converge closer and closer to its par value, hence the term pull to par. This is the story of both of these phenomena told visually. The prices of both bonds start out away from par. The price of the discount bond starts at 86.4097 and that of the premium bond starts out at 113.5903. What's interesting to note here is that since the coupon rates of both bonds are symmetrically distributed around the YTM, there's a 2% difference either way from the discount rate required to the coupon rates of both bonds. In keeping with that, the prices of both bonds are also symmetrical around par value, and they continue to remain symmetrical throughout their lives. And as you can see, other than time, no valuation related variable has changed, and the prices of both bonds, they converge to par value as the bond ages. So there we have it. That's bond valuation for simple fixed coupon bullet bonds. All we've done is work out the amount of cash flows and their timing, develop the appropriate discount and annuity factors, apply them as they should be applied, and we end up drawing a pretty picture of bond prices. And I guess that's all there is to bond valuation. You get the mechanics right, you get you work out the accurate effects of interest rates acting on cash flows over time, and if you get it right, you end up drawing a pretty picture. We end this video with one last section about bond pricing quoting conventions. It's another very important segment for both the exam and bond trading. Once we're done with that, you'll know pretty much all you need to know for the CFA Level 1 exam about bond valuation and how bond prices are quoted and calculated in practice. And you should then be able to confidently work through pretty much all the practice questions in the curriculum about bond valuation. The one final element in the bond universe, the quoting and calculation of bond prices. As you can tell by the caption, yes, there is such a thing as a clean price and such a thing as a dirty price for a bond. Bond prices are quoted per $100 of face value. So to say that a bond costs 99.1 means that $10,000 worth of face value of that bond will cost you $9,910, and $100 million of that bond will cost you $99.1 million. The only problem is that that is the quoted price or the clean price of the bond. It is not the price that you actually pay. The difference is the accrued coupon, also called the accrued interest or simply the accrual on the bond. Anyone who's quit their job in the middle of the month would be familiar with this. Sure, you didn't work till payday, but you still do get paid for the number of days you did work in that month. The same principle applies to the person who's selling the bond. Yes, they didn't hold it until the next coupon date, but that doesn't mean that they shouldn't be paid for the number of days that they did hold the bond. After all, holding the bond meant not holding something else, which implies an opportunity cost, which demands compensation. In this case, the compensation is the accrued interest, which is paid by the buyer to the seller of the bond. The addition of this accrued interest amount to the clean price equals the full price of the bond. And since it's not the clean price per se, some people also call it the dirty price. I mean, you know how bond traders are. So, for example, if a bond's last coupon date was 30th December and the bond paid a 6% annual coupon, then if the bond was sold on 13th April, the seller would be entitled to the 104 days of accrued interest, counting from 31st December to 12th April, both days inclusive. Effectively, the buyer pays the prorated portion of the coupon to the seller in advance, and effectively, the buyer gets paid for the 78 days of the intercoupon period that the bond actually was in their ownership. And that sounds about fair. To put numbers on this, if the clean price, as we had said, was 99.1, then for $100 million face value of that bond, the clean price would work out to $99.1 million. The accrued coupon, which the buyer has to pay to the seller, is the semi-annual coupon rate of 3% times 104 days that the bond was in the seller's ownership, divided by the intercoupon period. That's 182 days. That leads to an accrued coupon of $1.714 million. Check this result. It will help you firm up the concept and repeat it in the exam if required. You then add the clean price to the accrued coupon to come up with the full price or the dirty price. Like I said, it works pretty much the same way as if you'd quit midway through the month and your employer prorates your salary for the number of days actually worked during the month. Now, one more way of looking at the same thing is from the opposite direction. Not approaching it from the accrual perspective, but instead from the present value perspective. You simply lay out the cash flows and their dates as done in the first two columns in the bluish table above. and you assume that the prevailing yields on these on bonds of this maturity is a very precise 6.3147%. Now, that's obviously a reverse engineered YTM, which I worked out to obtain the clean price of 99.1. But the principle that I'm trying to demonstrate here isn't compromised by this bit of reverse engineering. Whatever the YTM that we use, and we'll just happen to use 6.3147% per annum, we use it to work out the discount factors for this bond over the 6 monthly intervals till the maturity of this bond, and then discount all the remaining cash flows back to 13th April, which is when the transaction took place. We sum up the cash flows and we come up with $100.814, which is the same price as we obtained by adding the accrued coupon to the clean price. So what we've shown here is that the clean price, rather the full price, is merely the present value of all cash flows of the bond discounted at the YTM back up to the date of the transaction. You subtract the accrued coupon from the full price, and that gives you the clean price. And that's the clean price is how bond prices are quoted in bond markets. It's also quite interesting to note that even though the full price is 100.814, and that is apparently greater than par, but the bond is still said to be trading at a discount because the clean price is $99.1, which is below par. That is because the clean price will remain unchanged for a given set of market conditions, while the amount of the accrued coupon, and hence the full price, will change from day to day. One more extremely important nuance that I would like to highlight here is the same one that I highlighted earlier, that the bond world lives, breathes, and calculates in 6 monthly intervals. So what we call YTM is really twice the 6 monthly discount rate that we use to discount all future cash flows. In the case of the presented cash flows, which are the same as we just showed on the previous slide, the discount rate is actually 3.1574% per half year. So when I said that the YTM was 6.3147%, I was using the convention of quoting YTM on a bond equivalent yield basis, which is how bond yields are actually quoted in practice. The idea is that you calculate the YTMs on a 6 monthly basis and then simply double them for annualization. To clarify further, you do your present value calculations on a 6 monthly basis. The interest rate that you use is a 6 monthly interest rate. The discount factors that are used to discount the cash flows, they are derived using a 6 monthly time horizon. That's shown in the column T, which shows the number of half years from 13th April until the next cash flow. So you work out the present value using these 6 monthly factors, but when it comes time to quote the YTM, you double the 6 monthly discount rate used to calculate the present value, and that rate, twice the 6 monthly rate, is called the bond equivalent yield. Yes, that's just nuance and convention, but it's also several possible exam questions that will look to test you and trip you up on your understanding of just this nuance and convention. So learn it, love it, understand it, have faith, practice, and you shall pass.